I guess we're now recording. Our mission is to more fully capitalize on SoCal's compelling diversity of talent, ideas, and perspectives by optimizing the conditions for SoCal's bold innovators to bring more breakthroughs to the world and further elevate this amazing region as a global leader in innovation, technology, and entrepreneurship. You got to take a breath before you say our mission statement. At our core, we are a super connector, facilitating relationships and amplifying impact across this high potential, yet very dispersed and diverse region. This year, we dramatically expanded our network and launched 2 complementary programs that support local investors and founders who are building their companies here in Southern California. We launched our VC engagement program and our VC advisory council that includes top ecosystem-minded VC firms located here in Southern California. You'll hear from several of them this afternoon as part of our panel. So I'm excited to have them here and excited to have those folks in our VC engagement work. And then again, on June 22nd, we hosted the launch event for the SoCal Venture Pipeline, a program that helps founders access capital. We're going to hopefully learn more about that today. This program helps founders, especially first-time founders, access capital networks that are sometimes difficult to access. We are particularly grateful for the support of Silicon Valley Bank and Rob Friedland, in particular, and Demarcus Williams for their partnership in this important program. We believe that SVB, as we call them, are perfect for this program. As you probably know, their clients include over half of the US startups and VC firms in America. So they're real experts in this area. I also want to acknowledge the great support also from Wilson Sonsini, in particular Kenji Funahashi and David Bailey for KPBB for also supporting this program and their service on our investment committee. What's particularly important here is their financial support for this program enables us to extend this program free of cost to founders who need funding and access. So no fees, no equity. This is purely to help great founders on that journey to get their Series A funding. If you succeed, we at the Alliance succeed as well. I do also want to invite you to the upcoming Alliance event on October 28th, which is focused on access to capital from seed to Series A. We'll have Minnie Ingersoll from 10110 and Petra from Wedbush Ventures and the founder of Star News Mobile, one of the accepted companies to the pipeline program as part of that conversation. Next, I'd like to pass it on to my friend and collaborator, Rob Friedland, who leads the VC relationship team for Silicon Valley Bank, to say a few words on what Silicon Valley Bank is up to and what they're trying to accomplish with this program. Rob, passing it over to you.
Thanks, Andy, and thanks to Rachel and Eric and everyone on the Alliance team for all your hard work. So my name's Rob Friedland. Andy got my title right. I am the head of venture capital relationships at Silicon Valley Bank. And I, for the last 6 years, have spent,
they're all founders,
lived in Los Angeles and actually ran the Los Angeles region for SVB.
Los Angeles SoCal companies raise money.
Somebody needs to go on mute.
Yeah. Hey, Peter Colbert. A little quick mute would be great. Thank you. So the, Silicon Valley Bank, for those of you who don't know us, we're the leading financial services company for startups. So we bank about half of all venture capital backed startups in the United States and more than half of the venture capital funds themselves. And what I can say on behalf of myself, Demarcus Williams, one of my colleagues, and then another Southern California colleague, Rod Teeple, who's also on the phone, is that SVB is, as the leader in financial services, believes very strongly that to whom much is given, much is expected. So this is one of our givebacks to in an attempt to try and simply benefit the ecosystem by increasing Southern California's access to venture capital. That's why we're doing it. That's who we are, and we're very happy to be here and trying to contribute back to the ecosystem.
All right, thanks so much, Rob. This is wonderful.
We're really excited about the panel we have next. I want to first introduce Demarcus Williams, who Rob just referenced as the moderator of our next panel. Demarcus.
Hey, Eric.
All right, Demarcus.
Sure, I'm here.
Welcome.
Thank you. Great. I guess I'll go ahead and just kick things off. So I will briefly introduce our esteemed panelists, and if the panelists don't mind giving a very, very high-level 10-second introduction on each of your respective backgrounds, just so the audience knows who you are, what you do, and what have you. So I will start with Renee LaBran. Renee, would you mind giving a quick background?
Sure, happy to. Hi, everybody. So I have been around the venture world for a long time. I was co-founder of a fund called Rustic Canyon Partners. Over the years, as that fund wound down, I joined in at IdeaLab, where I was an advisor and mentor for a number of years. And then I was also, I'm still on their board. Currently, I spend my time as a board member at IdeaLab. I'm on the board of B. Riley Financial, and I've served on a number of other boards. I teach at the entrepreneurship program at Anderson, and I work with a number of startups as an advisor and mentor, including some of the companies that come through Women Founders Network, of which I'm a co-founder, and we'll be kicking off. We have our event in a few weeks. So hopefully that was 10 seconds.
Awesome. Thank you. I appreciate it. Kenji, floor is yours.
Great. Thanks so much, Marcus. And thanks to the Alliance and Innovate Pasadena for organizing the event, and to all of you here who are interested in the topic. I'm a corporate partner at Wilson Sonsini, the Los Angeles office, and have practiced venture law for 2.5 decades here in Southern California, representing startups and funds in all stages of growth, from incorporation to IPO.
That was very quick. I appreciate it. Thank you, Kenji. Scott.
Hi, Scott Brovsky. I'm with UC Riverside. We run a program that helps founders basically scale, come out of the lab, scale, raise capital. And we've got a team of 15 mentors. We've helped raise about 35 million in the last few years for a lot of underrepresented and female founders in inland Southern California. And I'm a serial entrepreneur. I've done 5 startups, 2 in Austin and 3 in LA. And that's it. I'm happy to be here.
I appreciate it. And it might be helpful just to give a brief introduction on myself. So Demarcus Williams, I've been at SVB for just over 4.5 years. I lead our early stage group here in Los Angeles. And prior to joining SVB, I was actually an operator at an early stage startup here locally. So without further ado, I guess we'll go ahead and kick off the questions. So Kenji, the first question is for you, my man. What is Series A?
Great question, Demarcus. And broadly speaking, and there's no hard and fast rule on this, the Series A means the first institutional round of investments in a company by a venture capital fund. Now let's unpack that a little bit. Why do we call it Series A on the one hand, and what exactly is a venture capital fund or VC on the other hand? As we know, capital is the lifeblood to launch and sustain companies. And for the vast majority of companies in town and worldwide, capital is provided by the founders or the owners, by their family and friends, by banks in the form of lines of credit, and ultimately from cash flow through operations. Some companies, however, particularly in technology and life sciences, which is quite popular here in Southern California and in many of the tech clusters throughout the world, they require significant amounts of capital very early on in their life cycle to either develop a product, in the case of, let's say, robotics or life sciences, or to accelerate their growth rapidly to compete with larger, more established competitors, such as in the software industry. That's where VCs get involved, which are funds that invest capital in fast growth companies with the expectation of obtaining outsized returns for their fund's investors as a trade-off for the fund investing in riskier, earlier stage companies. And I believe that we have a number of panelists who will speak from VCs later on in this presentation. So in sum, a Series A is just a legal reference to the type of investments that VCs invest in. Now you may hear different phrases as well, like Series C. Now that just references a pre-Series A investment by potentially an institutional investor as well. However, whether it's a Series C or a Series A, when VCs deploy capital, they typically purchase an ownership interest in the company by acquiring what is referred to as preferred stock. And preferred stock has additional bells and whistles to protect an investor relative to common stock, which is stock that the founders and the employees own. Now, this preferred stock has a naming convention, and this is the alphabet soup of Series A to Series B to Series C. Now, preferred stock basically entitles a VC to a percentage of the company based on an agreed upon valuation of the company. Now, at a Series A level, that's at a relatively low valuation when VCs are coming in at an early stage and typically acquiring 10 to 25% of the ownership interest of the company, with the expectation that the company will put their head down, continue to grow the company or build the product, and then raise their next round, aka a Series B, at a higher valuation, and so on and so forth, until the company eventually goes public or gets sold.
I appreciate it. Thank you. Thank you for the definition, Kenji. Renee, question for you. So when investors are looking to invest in Series A companies, what are some of the metrics that those investors are really looking for?
Yeah. So investors are really looking to de-risk over time. So as Kenji described, there's a series of investment periods. And each of those points, people expect the company to be more and more de-risked. So what does that mean? So I think at Series A, what investors are really focused on is, has the company achieved product market fit? Okay, and I'm sure you all hear that term product market fit a lot. It's kind of, the holy grail for lean startup. But what does that actually mean? It means that you have defined your target market and that those target customers are buying the product. So you're selling them the right product, they're buying it, and you can serve them in an economically feasible manner. So people may have different definitions, but essentially you can show that you've got the right product for the right customer and the right economics. So how that manifests itself might depend on what business you're in, and that can drive the metrics. So for sure, it means showing customer traction. Depending on your business, it probably means revenue, but there are cases where it might not mean revenue. It might mean that you have a large number of users and maybe commitments for revenue. But by and large, they're looking for revenue. And the amount of revenue, again, will depend on what the business segment is. But something meaningful enough that it's not just a few $1,000s. It might be that you're closing in, for example, on $1 million run rate, and they'll probably look at run rate. I think it also, the other metrics would be around engagement, retention, repeat usage, things to show that you didn't just get someone to buy your product once and they're never going to come back. So if you are selling SaaS software, for example, they're going to look at your churn, they're going to look at your retention rate. Obviously, those are related. They're going to look at whether or not you're adding more seats at your customers, anything that shows that you are really selling them the right product and that they're willing to pay for it. And I think the last thing would be that the key team members are in place. Not that you would have your full team, because typically you're looking to expand the team, but you're not kind of, just looking to hire your first team members. You have at least the core, you have the core of a team. So I assume that, I'm sure that I've, left some things off there, but by and large, that is what people are looking for in a Series A, that you've demonstrated that this is an idea worth funding, and you have enough evidence to show that it's worth funding.
So I appreciate that, Renee. I think we need to give you a round of applause for picking up where you left off. All of the distractions. So you did amazing. So
what distraction? Thank you.
So the next question I have is, I'm a founder. I've raised my seed. I've hit some of the metrics. My revenue is there. At least I think my revenue is there. My customer retention is there. Like all of the metrics that you just mentioned, I think are there. So now I'm ready to pitch. I'm ready to put my deck together. What should I include in my deck? Yeah.
So, I'm a pretty picky deck person, as some of my colleagues on here know. I look at a lot of decks. And then I help my students at UCLA at Anderson write decks. But there's really a couple of things that people seem to miss. So the first thing in the pitch deck is to make sure that you're very, very clearly and concisely, what do you do, why do you do it, and how do you do it? I can't tell you how many times people will make like some very sweeping statement about how they're changing the world and whatever they're doing. And I literally can't figure out what they're doing. Like I have to ask them at the end, like, okay, that's great, but like, what do you do? So make sure that you are very, very clearly and concisely explaining what you do, and then why do you do it? So the why is really the problem that you're solving. So you may have something really cool, but if you can't articulate the problem, it's going to be very difficult for me as an investor to think about whether or not I agree that's a problem, and furthermore, to assess whether or not your metrics actually show that you're solving a problem. So that's the why. The other things around the why might be, well, let me get to that. And then the last thing is how. So what is it that you're doing to solve the problem that is so unique? So that's where you need to start, what, why, and how. Then you want to talk about the market. So we want to see a big and growing opportunity. And in that opportunity, a lot of times there's the why now. So why did this idea not work a few years ago? Because everything in venture, I'll tell you, like we've all seen over the years, right? But eventually things come back and there's the why now. So that's worth mentioning. What's your source of differentiation? So again, that gets back to the how. Why are you different than competitors? The worst thing you can say is, I don't have any competition. Like you will get thrown out of the room if you go for Series A and you say you don't have competition. So we can elaborate on that, but everybody has competition. And then your financials. So show me some reasonable version of what your financials might look like over 5 years. So how big are you going to get? What kind of profitability and how much cash are you going to burn in the meantime? What I don't want to see, and this is the other thing that will get you thrown out of the room, is this is $1 billion market. And if I just get 1%, I have this amazing business. Like that will get you thrown out, because it probably means, one, if you're talking about a multi-billion-dollar market, that you haven't really defined your market carefully enough. And it also tells me that you haven't built the bottoms-up model that will come up with a reasonable revenue estimate. So that's absolutely critical. The last thing, a couple of things would be, what are the milestones? So tell me where you are in the business today. So are you at, what stage is the product at in terms of building? Are you fully built out? Or are you just an MVP? What stage are you at? What are the key milestones that you will be hitting over the next several years? And then lastly, what are you going to do with the money? So if you say, hey, I need $5 million for a Series A, you need to explain to me what you're going to do with $5 million so that I can see that it's going to be used productively. So those are the things I look for, and a couple of watch outs that will get you thrown out of the room.
It sounds like, thank you, Renee. And it sounds like, in summary, it's just about how you as the founder are really telling that story, and telling that story of where you started when you raised a seed and how you progressed throughout, your journey and onto Series A. But really just articulating that in a very succinct way via your deck is really a differentiator. Not all founders can do that effectively, and the best founders do that effectively. So it's all about how you tell that coherent story.
Yeah, absolutely. Being able to tell, as you said, the story, but making sure that you hit all those points in a way that are cohesive. And there's some great examples online. The other thing I would just add in that story is, I think people in their deck often feel they need to add a lot of detail. And think about what should go in the footnotes if you're thinking about the story, right? Because what you're trying to do in that meeting is get someone interested enough that they'll dig into the footnotes. You're not trying to tell them everything in that meeting. So stick to the story, don't sidetrack, and don't try to tell too many details, but make sure that you at least share the important information.
And what are some of the questions you think founders should be prepared to answer when they're meeting with that potential Series A investor?
Yeah, I think you mentioned one is, how did you get here? I think most investors are interested in the journey because it says something about the investor's experience, their passion, what they're likely to focus on. So I think, how did you get there? I think talking about your team and the strengths of your team, you should probably mention that in your deck. I did leave that out. So who are the key people on your team? But you can certainly elaborate on that when you get asked questions. I think one of the questions that come up in these meetings is you will get questions about your financials. And I'm often surprised at how many CEOs or founders really don't know their financials very well. They had somebody build a model for them and they can't speak to it. So I would say be prepared for questions on your models, like, what's your customer acquisition cost? I don't know. Well, you should know your customer acquisition cost, and you should know what it is today and what your target is and how much it's improved. What's your churn rate? You need to know all those key metrics so that when you get asked, if you haven't already shared them in your deck, that you can bounce those numbers off the tip of your tongue. You'll probably get asked about risks, and be prepared, to be honest and how you're going to solve those risks. The other thing, I think that gets a little kind of tricky in a meeting is you may get asked about your valuation expectations. And that can be a tough one because you don't want to say something too low, you don't want to say something too high and scare them off. But I think there are some things that you can say. One can be, it's certainly reasonable to share what your last round was at, because at some point they're going to need to see that. You can talk about how much progress you've made since then, and therefore why you expect a higher valuation. If there's some metrics, meaning some other competitors that you can share that number. I would just be careful of putting a stake in the ground on a valuation, because if you make it really high, they're going to be like, oh, they're crazy. They have unrealistic expectations. And then if you make it low, they're going to feel like they're getting, they may feel like they can get a deal. So remember, the investor will tell you what it's worth. And if you don't like that number, you don't have to accept it, but you can guide them by sharing some other information.
Appreciate it. Thank you, Renee. And Scott, I'd like to direct this next question to you. So, in order of sequence, we have our metrics together. The founder, we have our metrics together. We're ready to pitch. Our deck is on point. It's solid. Now, I want to go talk to investors. When is the best time to start your outreach and your fundraising process with VCs? Scott, are you there? You're up. Oh, Rachel.
There we go. Thank you, Rachel. I couldn't unmute there. Sorry about that. Yeah, that's a great question. And Renee gave an excellent overview there, so I won't add to that. I would just say, start early, obviously. And I think that's obvious. We work with a lot of first-time founders. And so it's not always obvious if you're a first-time founder. We have a number of startups come to us and they say, hey, we're ready to, we've only got 4 months of runway left and we're looking to raise our Series A, as an example. That's typically not a great situation to be in. Also, think about time of year. So this isn't a great time of year if you're just kicking off a multi-month fundraising campaign. If you hit it hard for the next 3 or 4 weeks, that's fine. But typically, many VCs will check out a bit. Of course, don't want to offend any of our friends who are VCs who are on the call, but not typically a lot of activity post Thanksgiving, and so you have a little lull there for a lot of times if you're trying to get meetings. So think about the time of year. I think the biggest thing though is, as Renee already said, we have so many startups that come to us for help raising capital, and they're just not ready to raise capital. So I would say that, talk to a mentor, find a mentor, whether it's at a university program or one of the great incubators or accelerators that are around Southern California, or even talk to the Alliance. A lot of us know what VCs are looking for at seed stage and Series A. So I just would say, reach out, make sure that you understand what investors are looking for in your vertical. So as Renee mentioned, if you're a B2B SaaS company, you're going to be at a completely different metrics that you're going to be looking for a Series A than if you are a biotech startup or an ag tech startup. I would just say that we work with a lot of first-time founders who waste a ton of time trying to get meetings with investors when they're not ready, when they're not actually investable. So use the mentor network. SoCal has probably, I would say, the strongest mentor network in the country. Maybe the Bay Area is on par with it, but it's an amazing network here. So just get in touch with people who have helped startups raise money, and they will guide you.
I appreciate it, Scott. And one last question is, and this is, I'll direct this question to you, Scott, and Renee and Kenji, feel free to opine. But if I'm a founder and I'm thinking about, creating my roadmap for the next 5-6 months, realistically, like how long should I expect my Series A fundraising process to take?
Well, I'll let Renee answer that, but because we do more seed stage, but I will tell you that we just have done 5 or 6 seed stage deals. It took 8 months to close. And I know that that's not like, but also remember, we're working with, we're in inland Southern California. We're not in the Bay Area, but I don't know, Renee, 6 months probably for Series A in general. Oh, she's muted as well. So we went from, yeah, I think she's still muted.
There we go. Okay.
There we go.
Yeah. Yeah, I was holding up 6 fingers.
Yeah, I saw that.
Yeah, I think, 6 months is reasonable, but it really depends on, how much traction you have. I mean, honestly, I've seen, really companies that are doing really well get meetings and get funded pretty quickly. And Series A documents, are typically reasonably standard, so it shouldn't take too long to get done. But if you're not a known entrepreneur and you don't have connections, I would say allow 6 months, for sure.
Yeah, I appreciate that. Well, we have concluded our panel. I don't know if there are any parting words that our panelists would like to give or say to the audience. If not, I'll happily hand it over to Eric to proceed.
I would just say, just quickly, please do reach out, because you can save a lot of time, as I said, by connecting with the appropriate mentor or accelerator or network, because some areas are great in certain verticals. Like, for example, if I had an app, a consumer app, or a SaaS startup, Santa Monica is a great place to grow and scale. We out here in our region, we work with a lot of deep tech startups. We're doing a lot of ag tech and a lot of climate tech out here. And so, again, every region kind of has its specialty. So I would just, depending on what vertical you're in, I would reach out to the people that are here to help. And like our program, for example, at UCR, we don't charge any fees to any of the startups, and we also don't take any equity. It's a free service to startups. So I would start with programs like that, and then we oftentimes will introduce you, if you're ready, to one of the top accelerators like a TechStars or Y Combinator, et cetera. So anyway, just please do get in touch. And there's no reason in 2021 to flounder around wondering what to do, because there's, as I said, so many amazing people, like all the people on this panel, who are here to help you grow your startup.
Thank you, Scott. And it looks like Renee is patiently raising her hand, waiting to be called on.
There you go. Thank you. One thing we didn't talk about, I just saw in the questions that's probably worth mentioning, and you can ask the next panel as well, but people also often ask how much they should be raising. And I think, that's an interesting question. It obviously depends on the business, but you want to be able to raise enough that it gets you to another significant series of milestones, so you can raise another round. And in some businesses that might be 3 million. In some cases it might be 5 to 7. But that's why it's really important to really know what the metrics are for your business and what the milestones are and what it's going to cost you to reach those milestones. I think it also it gets confusing now, because there's sometimes, depending on the market, things that used to be, Series A become seed or pre-seed. And so that definition moves around a little bit, but, you don't want to be in a situation where you've raised money, but you haven't proven anything more and you need to raise money again.
There's one question here, and I actually know we have a few more minutes, so don't take the mic from me yet, Eric. I may have handed it over to you prematurely. But there's some questions here. One of them is, should we be raising for 16 months of runway? Is there a target number as founders are thinking about, reaching or their Series A process and targeting how much they should raise? Should they be targeting a specific timeline, 16 months, 18 months, 24 months? What is that number?
I'll jump in, but others can probably sees a lot of deals too, and he should comment. But I think, again, it goes back to, again, what are the milestones and how long does it take you to reach those? If it's less than a year, it's probably problematic because you're going to be needing to raise money again so quickly. So whether it's, 18 months or 16 or, 20, probably depends, but it could be 12. If you really have, if you're very good at the fundraising and you're going to have huge progress in a year. So I think it depends, but Ken, what do you see? You can hold up fingers.
Certainly, no, I echo that remark, Renee. I think that a couple of factors behind the amount of cash or the amount of cash necessary and the related burn. The first of which is, what's been the historical progression of the company to date. So, for example, if it's clipping at 100% growth rate every 6 months, then it's possible that between a Series A and a Series B, or in a Series B and a Series C, the timeline to raise the next round is compressed. On the other hand, to Renee's earlier point, the company shouldn't be in a position where it is running out of cash at the time that it's having discussions with the next round of financiers, because that can create negative signaling to new capital, as well as create potentially more unfavorable terms to the company. But I'd say anywhere between 12 to 24 months is what we typically see.
And I'll just add one thing we see a lot, and again, because we deal with a lot of seed stage investing. So just one quick thing, we have a number of, unfortunately, startups that are going through this right now, is they raise a seed round and they don't raise enough money to be able to hit what would be considered Series A ready investment. And so then they're scrambling around trying to figure out, okay, what do we do? Because we're running out of capital. We haven't hit a milestone, as Andy put in his comments, which are great, that make us Series A ready, and we're almost out of money. So I would just make sure that in both the seed stage and the Series A stage that you're raising is enough capital to be able to get you to hit the next milestone that will make you investable by that, whatever that next investment letter is, whether it's seed or A or B or C or whatever. That would just be my advice on that.
Awesome. Well, thank you, Scott, and thank you, Renee, and thank you, Ken, for this awesome panel. We ended right at time. So
there you go. We're pros. Thank you, Demarcus.
We are.
Appreciate it.
This isn't our first rodeo.
That's right. Thanks so much.
Yeah, my pleasure. Over to you, Eric.
Thanks, Demarcus. That really was a wonderful panel. Thank you, Scott, Renee, and Kenji. Lots of great tidbits there. The importance of metrics and communicating those to investors. Kind of hard things like customer acquisitions, what your last fundraise was at, the valuation, and then also just how long it takes to actually start your fundraising or complete your fundraising journey. Anywhere from 6 to 8 months is kind of what we heard from the panelists, depending on kind of the ecosystem and where that startup is and what they're able to show. So good things to keep in mind. While our last panel kind of focused on what founders need to do to prepare for the Series A raise, the next panel that we'll be turning to shortly will focus on how founders should manage that process. And we've got a really stellar second panel here for you. At the beginning of this event, Andy talked a little bit about some of the programs that we launched, one of which being our VC engagement program, which has our Alliance VC Advisory Council. And I'm delighted to introduce or start this panel with a number of our VC advisory partners. So we've got Rob Freeland from Silicon Valley Bank, who leads VC relationships, who's going to be invited back to moderate this next panel and to introduce his panelists. Rob, over to you.
Terrific. Thank you, Eric. I'd rather than give bios for people that are on here, which I'm loath to do. I'm just going to turn it over to my esteemed panelists to introduce themselves real quickly. But my panel is Anna Barber, Jason Shetler, and Jed Lighthizer. We have a couple of tactical questions. We'll try to leave a little bit of room for some Q&A, but we're going to dive right in after the introduction. So why don't we go in that order? Anna, then Jason, then Jed.
Thanks, Rob. Hi, everyone. It's great to be here. Thanks to the SoCal Alliance for putting on this event. And it's great to see so many familiar names and faces in the Zoom room. So I'm Anna Barber. I'm a partner at M13. We are a consumer-focused Series A fund based in LA with an office also in New York, investing in the future of consumer behavior, mostly technology-driven. And I also run our launch pad there. So I also work with early stage companies. Previous to this, I was managing director of Techstars LA. So many of you may know me from that. So I've got a lot of early stage experience of helping companies raise their first rounds of capital. And I was also a founder and operator myself. So I went through the fundraising process myself several times. And so I'm excited to discuss this topic with you.
Awesome. Thank you. Jason.
Thanks, Rob. Thanks, Anna. My name is Jason Shetler. I am a co-founder managing director at Calibrate Ventures. We're a Pasadena-based VC firm that focuses on seed and Series A investing in digitalization and automation technologies. We've done a lot in AI, a lot in robotics, and a lot in enterprise SaaS over our careers. And we're delighted to be here. So thanks for having us.
Awesome. All right, Jed.
Awesome. Thanks, Rob, as well as Eric, Rachel, everyone else. Happy to be here. Jed Lighthizer. I'm a partner at March Capital. We're based in Santa Monica. We're full series investors, meaning we invest everywhere from the Series A all the way to exit. Got about $1 billion under management. I've been an investor here for the last 5 years, in the industry overall for 7 years, and really focus on two things: enterprise SaaS and fintech. And just a note for, I think, Renee and a few others that are nationally on the call, I went to UCLA Anderson for business school.
Nice. I can't claim the same for myself, but I can say that I'm here excited to be here in Southern California, and I'm here by choice. So let's kick off. I'm going to open this up to all the panelists, and we're going to start with a really tactical question. So if you were a founder and you were looking to leave your, let's call it an engineering job at one of the great companies here in the United States, and you're thinking about moving either home to Southern California or, across town to do a startup with a friend that you've always had a great idea about starting a company, and now seems like the right time. What are the first few moves that you would make? In other words, you've got an idea, you need to raise capital, but where do you start if you're a founder? And maybe in the interest of trying to get everybody a little bit of airtime and make certain that we hear from everyone. Anybody who wants to start can start, and I'll probably call on the other two of you for your thoughts.
I'll jump in and kick that off, Rob. I think that's a hard question to answer because I think it's so different, depends on so many different variables. But I think one thing that we certainly appreciate is the focus on the customer. And what I mean by that is if you're thinking of leaving a job, having an idea around who your customer is and how to service that customer, and placing that person at the center of the universe, and then trying to figure out how do I serve that customer with my, my friend, or if I'm going to pick up and move to a different geography where I think there might be more talent available. I would try to use that as the true north. It'll help you identify the problem that you need to solve, whether you're actually able to deliver that solution, and give you a chance to enroll some people along in that journey. Because I think for many different people, that path could take, many different ways. If I've learned one thing in doing venture for over 20 years, there's no hard and fast rule. There's some really important guideposts to look at, but I'd say having those, for trying to find that true north and keep it in your sights is really, really foundational.
I'll just add that the scenario that you described, Rob, to me is talking about a pre-seed round. So, when we think about a Series A round, to me, that's no longer really the first institutional round of capital, because we've had these institutions develop that are focusing on earlier stage kind of pre-Series A investing, and they're actually institutional pre-seed investors. So when you're thinking about a company that's really just an idea, that's really a pre-seed round, and then by the time you're doing your Series A, you've likely it is possible to bootstrap your way into a Series A. And I think sort of in earlier stages of the venture capital ecosystem development, that was probably more typical. I think now it's more typical to have pre-seed investors and then seed investors kind of laddering up to a Series A investor. So if we're looking for your first capital, I would say it's having thought deeply about the problem and really coming with a specific lens and point of view about your understanding of this particular customer pain point, probably with some customer research that you've done and some actual data from the market and an idea of how you'll approach the very first step to de-risking. To answer the question with respect to Series A investors, I think there's a number of ways of making those right relationships, one of which, and I think the best one of which in my experience, is an introduction from another existing portfolio company. So if you have a relationship with a founder of a company that venture firm is already invested in, that is a person that they trust and believe in enough to have written them a check. And so it's a very strong reference for you that if you get an introduction from an existing portfolio CEO, they're saying to their investor, this is somebody that I think is highly capable. So that's a great investor. That's a great introduction. Another one would be someone who's already on your cap table. So someone who's already invested in you making a reference, obviously they really believe in you. But I think one really interesting thing that I've seen crop up in just really the last year is the advent of the cold email introduction being really successful. And I think there's a right way and a wrong way to do this cold email introduction. I think the wrong way is not a personalized email. So as a generic email, I tend to just delete those because there's nothing in the email about why my firm and why me specifically. So if you are going, don't shy away from the cold outreach, do it. Those emails are getting read, but make sure you've done your research and put in the work to understand why that firm, why that particular person, what else have they invested in that's relevant? What in their portfolio speaks to you? Why do you think they'd be able to particularly help you? And those are going to have a better result and a better response rate than just a pure cold outreach. And then the final thing that I'll say is that there's this great new initiative, the SoCal Venture Pipeline. And I'm looking forward to getting introductions and deal flow from that. So I would encourage anyone who's going into raising a Series A to check that out.
Awesome. Jed, anything to add, whether it is, an early round or a Series A round on sort of the best first move for the founder?
Yeah, what I think I'd say, just kind of start things off, is a good reminder. I was looking at a lot of the deals we've looked at since I've been here the last 5 years. And I think of the, shortlisted deals of the first stage, only about a third of the founders had, previously been founders or been in the C-suite before. So I don't think that can stop anybody. I will say the majority do have a co-founder with them. And often there's at least one person who's more technical. There's at least one person who's more go-to-market. I think the thing we've always seen is that the founder or founders always have a unique perspective on the market. And that may be informed by, they were doing something similar at a big company. They want to solve a problem and create a startup. It could be someone who is completely outside the industry and is adopting kind of a beginner's mind type approach. But I think the ability to really kind of convince people, whether they're investors, whether you're co-founders, et cetera, to kind of, join bands and get together is probably the most important point at the early stage. And it comes in lots of different ways. I was kind of looking through our portfolio, and I think by the time they get to the Series A is where we start investing here as March Capital. There's a company called Earnin, which is a consumer finance company that's in our portfolio. And frankly, it wasn't a space we were interested in investing, or we didn't know we were interested in investing. It's maybe a better way to say that. They focus on breaking the 2-week pay cycle and unlocking that. And after meeting with the founder, we were quite frankly floored with his ability to kind of describe the problem in the market and the scale of that problem, which were, 50% of people can't find $400 in emergency. It was also that, people spend more on late fees than they spend on alcohol. And the staggering kind of, billions and billions of dollars on overdraft fees. And, this individual, Ram, had also, hadn't been a founder, hadn't been a CEO, but it sort of worked at a company that had maybe a similar social / financial combined mission. And he started kind of doing this on the side. And so by the time it got to Series A, there's actually kind of proof points, both financial and non-financial, that, even though this was an nascent market, that it possibly could kind of work. So I think that's kind of a long-winded way to say, like, it depends. But I think kind of looking at some of these examples, you can kind of tell what it takes and maybe find a route for yourself as well.
Nice. Well, let's talk about the ongoing process, because those are some, I like Anna's reminder that we shouldn't forget the cold intro or the cold email, because it does work if you put the time in. Let's talk about, once you have that first meeting, or as you're approaching that first meeting, how do you manage the ongoing communications? And let's say whether it is somebody with whom you're going to have a meeting or you've already had a meeting, how do those differ? Anna, do you want to start?
Sure. So first of all, like, we're talking tactically about managing the process of raising a round, which is, specific. We're talking about Series A, but this really applies to any fundraising round. So first of all, I think a lot of the work happens before you even hit that meeting. So what you have done in an ideal world before you hit that meeting is that you have set up, you have a really solid deck that tells your story, that kind of maps to the talk track of what you're going to discuss in the meeting. And if you have done, I think, the right work, you will have also developed a series of frequently asked questions. What are the questions you think you're going to get in the room? I actually have a series of questions investors ask. I'm happy to share or post or send out. And then you can actually prepare answers to those questions, so you're kind of ready and you're prepped. You should also be ready with follow-up due diligence material, because we are seeing things move quickly. And if someone's interested and they'd like to have more information, you could follow up quickly with them to provide that information in the form of a data room. It makes you look really on top of your process and your company, and it allows them to go with you to create momentum into that round. The second thing you've probably done is you've built your target list of investors. So you're not having one-off conversations without running a process. You want to either be fundraising or not fundraising. You kind of don't want to have one foot in, one foot out. So once you're in that initial conversation, you've likely also set up other meetings behind it. You've also done other outreach. And so you're ready to have multiple conversations contemporaneously, in order to rapidly get feedback and understand how your story is landing, and also try to create a process. So once you land in the meeting, what you want to do is really, you want to listen more than you talk. So you're going to pitch and you're going to start out pitching, but what you're really doing in the meeting is listening for where their questions are. Where are they digging in? Where are they really curious? The best meetings become conversations, and the very best meetings become joint problem solving sessions where you are working with that investor to build on each other's ideas. So they are actually collaborating with you around ideas for the future of your business. If you can get to that point, you've made a great connection with someone and you've established that they're excited about what you're building. But in order to do that, you have to really show up with like a curiosity. And it's hard to do that because you kind of want to get in there and pitch. But if you can pull back from doing that and look for how they're reacting and watch and listen as much as you're sort of talking and pitching, I think that's going to be a better result.
That's a great suggestion, Anna. That is hard to do. Jason, any suggestions around either the prep or the ongoing dialogue, how to get someone into that conversation that is a two-way interaction? Yeah,
I think there's two things that I would point out. I think Anna has hit a lot of really important things on the head. I think I would highlight two things. One is to do homework before you even build your list and go out and reach people. Fundraising is a sales process fundamentally. It's an active process, and it's really incumbent on the founders to drive that process through to a successful completion. And a really important part of that I see a lot of founders miss sometimes is the qualification process that any salesperson would do in the course of their job. So that is trying to understand, the budget that, if I go to talk to our sales teams at our companies, we're talking about budget, authority, need, and timing. Those are the 4 key things that are fundamental to any sales process. So is the firm or the fund that you're talking to deploying capital now? Are they fundraising themselves? Are they early in deploying their next fund? Understanding their reserves. That's all an important part of trying to understand whether you've got a fit with them. Secondly, what is the sales process? Are there 12 partners? How do they make decisions? Understanding the pecking order. All firms have a little bit of a pecking order. Some have a big pecking order. Others have less of a pecking order. But understanding where the person that you're trying to get introduced to fits in that pecking order is absolutely crucial to getting the deal championed at investment committee and then ultimately approved. I think making sure you have alignment with stage. We're talking about Series A here, so I don't look at a lot of pre-seed. I don't look at any pre-seed deals, so don't send them to me. But I'm happy to look at Series A deals all day long. For us, that means a specific thing, and we've written about that and talk about that in different forums. And it's important to understand that you're on target with. Scott talked about ag tech deals. Send the ag tech deals to Scott. Don't send the consumer deals to him. I think it's really something that I see a lot of founders miss if they don't have a lot of experience. And then finally, just understanding the timing. It does take time. It takes 6 months it can be faster than that, but plan for 6 months to run the process and put energy into it. And those are the things to qualify and understand up front. You said it's bi-directional. The second thing I would really encourage people to do is do your homework on the partners and the firms you are thinking of taking a term sheet from. It's not a one-way street. It is a two-way street. You're looking for a partnership, and it's important to be asking questions. It's important to listen, like Anna said, but it's also important to ask questions, not just in the context of the pitch, but to your friends, your colleagues, your other co-founders, other investors, to get a read on whether taking money from XYZ fund is the right, is a good fit for you.
That's great. Jed, do you want to give a little perspective on a specific company you've invested in before?
Yeah, let me just add a little bit on the process, a few other kind of pointers that kind of came to mind. I would say when you run this kind of process, there's ideally a process you've kind of nurtured, you understand who you're going after, you know who you're speaking to. You also want to prioritize the lead investors. There's a lot of folks that can, follow on to a round. In my experience, those folks are quite easy to get to the table once the round is materialized. But a lot of folks kind of spend an inordinate amount of time kind of on those investors. So I just prioritize the ones that can, set the terms and lead the round. The other thing I would say is, focus on what the goal is of each meeting. So the goal of usually most meetings, including the first meeting, is to get the next meeting. And so don't feel the need to kind of brain dump. Don't let all the details, complexity of what you're doing and going after get in the way of building the relationship and telling the story. So usually kind of a first meeting, if I'm going through a deck, it's not just kind of a coffee meeting, then I really want to emphasis on story. I really want to understand sort of the why now, what is the behavioral change or technology change or both that you're capitalizing on? And you're really kind of educating the VC in most cases in that capacity. And then you really got to convince them that you're uniquely qualified. And again, to come to my prior point, doesn't mean you've been the CEO of a similar company before. You could have the qualifications that are pretty unique, but it could be just a unique qualification. And then just to give a kind of a few key metrics to show that what you're doing for the Series A is really getting adoption. And then also kind of say, hey, what does this money help you do? What's kind of the next milestone? What does this de-risk this amount of money? But again, try to package that up in a pretty short format. Err on the side, I'd say, of scheduling shorter meetings, not longer meetings. You generally want the VC wanting for more versus an hour meeting that only lasts kind of a half hour. It's kind of awkward. It doesn't build that momentum. And then you can always follow up, with, detailed financials, the data room, all that stuff kind of helps people get more comfortable, builds the momentum, but it's not something you sort of need to kind of throw in the investors' face. So I think in the process of fundraising, those are the things that come to mind. I think the other thing I would say, regardless of stage, is probably the founders that get the, at least in my experience, kind of the most interest, the most term sheets. They do a great job of convincing the VC that cash is really the constraint. They know where to spend the money effectively. They know what they're going after. And the corollary is actually more important often. They know what they're sort of not doing. They're not trying to do 500 things. They know what their gaps in leadership team are. They kind of know what they're going after. And then the more, to the extent that you can, and in terms of tactics, convince the VC that you'd be successful even without their money. Yes, the VC can help in certain ways, but they'd really be kind of lucky to be part of this company. I think that's something that gets people really excited and gets them a lot of term sheets.
And that is a high class problem to get to that point. So we've got about 8 minutes, and I want to ask a couple of quick questions. So Jason, you touched on something around the stage that any one company is in, right? You look at Series A, where Anna has historically looked at a lot of early stage deals earlier than Series A, and so has a good sense of a very different set of the market. What do metrics look like? What is a Series A deal? And you can be specific if you want to. You can provide some general guidelines, but help everyone get a sense of where are they?
We're in a very interesting moment, I think, in venture land. I think that Series A can mean a lot of different things. We're seeing very large Series A rounds get done, and we're seeing more conventional Series A rounds getting done. And so I think that it's tough to put a really fine point on it. I can speak for us when we talk about Series A, and I think what that means for us, and I think we heard earlier from Renee about this. You've established product market fit, so that's really important. So there's a product, and there's some sense that you've achieved customer traction, whether that's actual revenue generating proof points, or whether that's engagement proof points, or whether you've got early customers willing to play with it. So I think in all the stuff we've done recently, it's been one of those three things. And I think in terms of metrics, it really depends. I think in terms of the range, I would say is no revenue, but really great engagement metrics around the number of customers and the monthly growth you're seeing and utilization of the products. That's one important data point. And then I think on the other end is revenue proof points, and I think we've seen early revenue of $500,000 to maybe 5 or 6 million fit that zone. I think the range has opened up dramatically in the last year. I saw a question about, how has COVID or how has coronavirus changed the deal flow? I think people are getting a lot more efficient. I think, doing these pitches over Zoom, I think the velocity of deals and the velocity of capital happening in the pipeline is increased significantly, this year versus the last 12 months over the prior 12 months. And I think that means that maybe those parameters are not so neatly confined as they were. For us at Calibrate, we look at the last 15 deals we've done. Median revenue is probably about 1.2, 1.3 million. So obviously some companies had more revenue, some had less revenue. But I think it is in that zone of kind of early commercial success, the great promise of what's ahead, and looking at doubling or tripling revenue over the next 6 months, and then doing that again over the next 6 months after that.
Yeah, just to add to what Jason said, I think at M13, I also looked back at our deals, and our revenue number for our Series A deals, in which we were the lead, is in the same range, just a little bit over $1 million. And, but really all over the map, we have companies that are still pre-revenue, for which we have led Series A. And we have companies with revenue north of 5 million for whom we have led Series A. For me, I think one sort of philosophical shift between seed and Series A is whether you've moved more from learning to grow into activating growth. So at seed, you're mostly still testing how to grow, which is related to product market fit or being pre-product market fit. Whereas at Series A, you're starting to actually grow in a repeatable way versus just still learning to grow or still being in the testing phase. And one thing that relates to for me is something that's a bit of a pet peeve, which is kind of use of proceeds and how that's presented in your deck and in your story. I really don't like seeing use of proceeds described as runway or a headcount increase or kind of how you're going to spend the money, because that is not building confidence and telling a story around your ability to know where you're going and what you're trying to achieve with the capital. So from a storytelling perspective, to build confidence and really build the case that you know how to grow. We want to know what your metrics are going to look like after you've executed all those things. Of course, on the way, we want to know what those things are, but where are we going to be at this point in the future when you've executed all those things?
Jed, anything to add?
Yeah, I would say, looking back at our portfolio companies, I think the ones that were in the enterprise SaaS or maybe a middle of the fairway consumer fintech companies were kind of at that $1 million run rate at Series A. I think now what I'm seeing is that a lot of the Series A deals are kind of more at that 500K, probably half that, thereabouts. But they have some interesting kind of non-financial metrics. They've done a good job of getting feedback from potential customers, and they've really built strong teams. We have one investment now, it's still stealth. It's software-based technology is what I'll say, in a previously hardware-centric view. No traction, no product built at the Series A, A+ in terms of market, assuming they can, digitize that market, obviously, A+ team. And so there it was, like I said, much more in the potential customers figuring out, if it's a real problem, if they thought a solution that was software enabled was something they could buy. So it does vary, I would say, depending on if you have those financial metrics or not. I think the key thing, I would say just here at March Capital is seed is mostly a phase more than it is a stage. So if I kind of group the pre-seed and seed and potentially a seed 2 together into one phase, the traction isn't as important there. Like, people aren't looking at the year-over-year growth rate as much, or at least I should say I'm not, just because the numbers, are so small, the percentages get so big. But kind of once you get to a few 100K in annual, then people start to really look at what those tractions are, and they feel like you have, multiple customers. So there's some portfolio effect going on there. And so that's when the traction becomes really important. I think all the Series A's we've invested in, they at least have some metrics to note of, excluding that one I mentioned, kind of show some level up and to the right. They show some kind of fanatical customer whose problem you're really solving, and whether that's kind of number of downloads or just daily usage, the monthly actives and the daily active, or whether it's revenue, it almost doesn't matter. It just depends on the business. It's just important that you really identified, as others had said, that product market fit, and then there's a prospect to kind of monetize that in the future.
One piece of advice I gave someone recently, I'm curious to hear if it resonates for the three of you, is that the phase of the round is and required revenue traction is directly correlated to the size of the market and or the prowess of the team. And so serial founders can raise a Series A with no trouble, with no revenue. Companies addressing $1 trillion market and showing good user base, growth with no revenue can also raise a Series A much faster. But if your revenue is easy to acquire, or if your market is smaller, you're going to need to show more revenue traction.
Yes.
I think that's right. I mean, I think today's revenue is just a predictive input that allows us to predict an exit outcome. And so what are the other factors that go into predicting an exit outcome? It's the quality of the team, it's the size of the market, it's velocity. So it's not just looking at revenue at a point in time or metrics at a point in time. It's, what is the trajectory of those? So I don't think revenue by itself you can't look at revenue in a vacuum. You have to consider all of those other factors when we predict a potential exit outcome and the likelihood of that outcome occurring. It's only one of many factors. And that's one of the reasons why you see this range in revenue numbers.
Yep. So one last quick question for one or two, in just a handful of words, is there anything you can do if you have a whole bunch of interested parties that might be followers, but no one to price around? Anna, this is I think right up your alley, but Jason, feel free to jump in. I know you have some strong opinions here.
Yeah, I think, I think if you really have interest in closing a round and all you need is a lead, I think that there's two things you can do. One is you can try to price the round yourself and work with, the most interested and the most aggressive follower to convert them into, hey, look, I've got the round fully subscribed. If you and I can agree on terms, let's get this deal done. Here's what I'm thinking and here's why. A lot of the reason, and that may work. That may not work 100% of the time. And I know you said a few words. The other is just try to go find somebody with a smaller check who can come in and help price it. I think momentum, and for a lot of followers, they like to, they don't like to necessarily stick their neck out. And if you can find somebody who's willing to do that, I think that's what you got to do. There's no magic to it. You just got to find somebody willing to write that check, and it's got to be somebody who you will bring that capital along as well.
Anna?
Yeah, I mean, I appreciate, the point, Jason's point earlier, that you want to focus on talking to the investors that can lead and price the round. It can also be really helpful when you go in to talk to those investors if you already have some of the round circled, because it de-risks it for them. If they end up sticking their neck out and saying they'll write you a term sheet, that they know that there's other people that are going to follow that term sheet. So it's a little bit of a chicken and an egg problem, but you definitely don't want to end up in the position of, I have one company actually in my portfolio raising right now that has 25 million circled of a $20 million round and even a price agreed, but no lead. So they're in this kind of difficult position, and they think they may have just secured a lead who's willing to write a $1 million check to price the round. So that's going to end up being a very weird deal, because it's very unusual to see a $25 million deal with a $1 million, lead check. But they just kind of got backed into this situation because they ended up getting all this follow-on capital without, finally securing a lead. So, it does happen. It does happen. And you have to kind of talk to some of those follow-on investors also, just because it's a little bit of practice, and you don't want to necessarily go to your target dream lead investor as your first meeting when you're still warming up. So there could be some advantage to doing some of the other meetings first and getting warmed up, and maybe you secure some follow-ons and then you go and talk to your, ideal leads.
Jed, anything to close us out?
Yeah, I think that's about right. We've seen portfolio companies and, just good companies in general that, have insiders that price the round, right? And so they may be leading 2 rounds, or they were following the prior round, and now they're leading this round, kind of, and or just a smaller check from an investor. So maybe they're taking only 10 to 20% of the round. Probably they want 20% of the round, at least the enterprise companies we've looked at. But that happens quite often. So I would certainly encourage that. I think the other thing is, I still believe that seed is the phase. And so if you've maybe raised one, round of capital, and your metrics maybe aren't Series A ready, you're kind of constantly comparing yourself to others or questioning, which is, not always advisable in itself. There's a possibility to raise another seed round. I think that's something that, we find is totally acceptable. And then when you feel like you're more confident and you got, traction or product and team, kind of whatever you think is missing for you to really get that confidence level, then you can raise a Series A. And so I think that's maybe different than the example that was kind of just mentioned, but for some more generic cases, that could be the answer.
Terrific. Well, thank you, Anna, Jason, Jed. I think some of them will be here in the breakouts, and we really appreciate your perspectives. Eric,
Thanks.
Back to you.
Thanks, Rob. And Anna, Jed, and Jason, thank you so much. This panel was amazing. I hope you enjoyed it as much as I certainly did. Felt like you really kind of pulled back the curtain a little bit on how people look at your pitch deck or evaluate funders or founders when they're seeking capital. We're in this stage where investment's kind of changing. Some of the other things that I heard is, there's different strategies. It's important to have a lead, and we heard some strategies on how to identify and price around based on who your lead investor is. Also, listen more than you think. And if you get to a conversation, like Anna said, that you've really made a great connection. So I think these are all really helpful recommendations. I wanted to introduce real briefly Rachel, if you could, who's helping to moderate, and myself. We're together supporting this program, the Venture Pipeline Program. And if you're not sure about where you're at, or if you're Series A ready, Rachel and myself are both resources. We would love for you to submit an application, and we can give you some honest opinion on where we see you at in this process, and give you feedback. And if you're ready, we would love to take you forward and introduce you to an investor that can most likely fund your startup. So thank you so much. We're going to be shifting in the last 10 minutes or so to a breakout session. We do have some of our panelists, including Jason and Scott and Kenji from Wilson Sonsini, all going to be kind of in these breakouts alongside the Alliance team. And this will be a chance to kind of network, ask some questions that maybe perhaps that weren't answered. But hope to see you all in the breakouts session. I'm going to share my screen. And we're gonna, these are the prompts for the breakout session. So real quick introductions, name, org, and what's your ask. And if we have time, what's the biggest takeaway from today's event, and what are you looking for? And so with that, we will be breaking off into breakout rooms. And my colleague Rachel will be assigning you into those rooms, and hopefully you have a great discussion. Thank you.